Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello everyone, I'm here with Tina Howes from SmartMove, one of Australia's leading and award-winning mortgage broking firms. And we are here to talk to you about all things property finance. So hello, Tina.
Okay.
So picture the scene, everybody. You have bought a property, you have your new loan, probably over a 30-year term, and you're doing the numbers and you are dreading the thought of still having a mortgage in 30 years' time. So Tina has some key tips for us to ensure that this doesn't happen and how you can repay your loan off sooner and or create a buffer that you can draw on if you need to. It's really, really important, all this stuff. So Tina, tell us.
Okay. So if you have gone to a bank and obtained a loan in the last couple of years, I can tell you that there is definitely a surplus in there. There is some kind of buffer whereby you financially have the capability to put aside additional money over and above your living expenses and mortgage repayments. And that's because the bank uses an assessment rate, which is an interest rate that is higher than what you're actually paying.
Yeah.
And that assessment rate is well and truly beyond where interest rates are at the moment. So I guess my key tips are finding some innovative and some, sometimes very obvious ways of trying to make additional repayments or reduce your living expenses in order to be able to get ahead on your loan. Okay. So the first one would be to obviously increase the repayments on your loan. Now, I have kind of two ways that I like to potentially do this. Now, the first is to download an app. If you go to the App Store and you find one that says loan repayments, there's multiple free ones out there.
Yeah.
But if you put in your mortgage repayment, your current interest rate, and then you play around with that 30-year loan term, maybe try a 25-year, try a 20-year, and see what that repayment is. And then obviously stick to that repayment and try and make that repayment into your loan to an offset account. Now, the beauty of that is, saving is hard. Making additional repayments isn't easy. It means, foregoing the here and now and putting aside extra money. But if you can psychologically see that, well, actually, I'm going to be paying off my loan sooner, I'm getting to that goal of being a homeowner sooner, then it will help you make those repayments and stick to that goal.
Okay. Can I just interject really quickly? You started that off saying, it sort of sounds, you're stating the obvious or it seems obvious. I think also actually to a lot of people, it might not be obvious. People don't often realize that they can make extra payments, right? That it's all kind of set in stone by the bank and that you can't do that. You can. Yeah.
And look, if you have a fixed rate loan, there may be limitations on your extra repayments, but even under those conditions, you can generally make some kind of extra payment over a year. But if I've got some numbers, so if you have a 30-year loan term and you change it to 25 years, this will increase the repayment amount slightly. So if you had a $500,000 loan over 30 years at say 2.5%, that repayment is $1,975 a month. If you tweak that to a 25-year repayment, then the repayment only goes up to $2,243 a month. Now, it's an increase of $268 a month or $67 a week.
Right.
Now, it's all relative to every individual, but this could be the difference of, eating your lunch, taking it from home, not buying as many coffees out, not buying that muffin at lunchtime. And there you are, you've repaid your loan off sooner.
It's got to be a good muffin for $67.
Yeah.
Huh? That's right. Yes.
5 days a week, Kate.
That's right.
The second way that I would suggest is it's also very similar. And again, use that app that you've downloaded, but play around with the interest rate. So it's going to have the same effect if you increase the interest rate. It's going to make the repayment higher, and you're then going to be creating a surplus that will enable you to get ahead on your loan and pay it off sooner. But the thing I like about increasing the interest rate is, so, you know, if you pick up the newspaper, every day you will see something about interest rates are heading up. And if you haven't fixed your interest rate and you're on a variable interest rate, then you're susceptible to those interest rate rises. But if you calculate your repayment with a 1% increase in there, you're going to be getting ahead on your loan. But it also means that when you read those scare tactic articles, you can ignore those and go, that's all right, I've got rate rises covered. We're already ahead.
I'm already doing it. I'm
already doing it, and I can personally afford that. So I'm not going to change what I'm currently doing, and I'm just, you know, paying my loan off sooner.
I love that, Tina. Can I just say, I love all your tips, you know that, but this one in particular, I think is quite powerful, you know, in terms of, I think psychologically, right?
Absolutely.
When you increase that interest rate on what you're paying, so like you've said, you're going to be ahead of the game. When interest rates go up, they will go up at some point. You're going to be doing that already anyway. And I think just psychologically, it feels like you're building in those buffers already. I think that's really powerful. I had a client recently that they felt very comfortable with the loan amount that they were borrowing. They decided to not opt for fixed interest rates, which were at least 1% higher than the variable. And they decided from the day one to basically start paying the interest, stay variable, but start paying the amount that it would have been had they chosen fixing. So in a way, they're self-hedging. And they're creating that buffer so that when rates do eventually go up, they can dip into that if they need to, or just get ahead on their loan. And also, you know, monetizing, sorry, just going back to number one there really quickly, monetizing that is I'm a great believer in monetizing everything that, you know, if you're scared about something, monetize it. What does it actually mean? Work it out. And $67 a week to shave off 5 years of your loan, off your loan, I think that's huge for $60.
Yeah, absolutely. Right? And once you start, then you're like, well, how do I find another $67?
That's right. Turns into a bit of a game, doesn't it? At least when you like.
And I'll cover off some tips on that. So this one's for the people out there that have an owner-occupied home and an investment property. So chances are, if you have an investment property, that you probably, likely, under the advice of your accountant or advisors, will have an interest-only loan. So my tip to you is, because the reality is your interest-only loan will not continue indefinitely on interest only without a reassessment to the bank. And who knows at that point in time what the bank's assessment criteria will be. So you may be forced to revert to principal and interest repayments. But a really nice sneaky way to get your head around that and also be ahead of the game, and also putting more money aside, is to work out what the principal and interest repayments on that investment loan would be, make your interest-only payments, but into a separate bank account or into an offset account that is against your owner-occupied loan, make the equivalent principal and interest repayment. So from time to time, you'll have some expert that recommends that you should pay principal and interest on your investment loans. Everyone has a different viewpoint on that, but that's my suggestion: is make the repayment, but have it against your home loan. And I'll probably need to elaborate a bit what I mean by that. But you're still getting your overall debt position down, but by having it against your home loan in an offset account against the home loan, you're therefore reducing your repayments overall, you're reducing your interest, but you're still creating this nice safety net and buffer so that if anything does go wrong with the investment property, you've got that there. Or heaven forbid, if you can't extend your interest-only period beyond that initial 3-year or 5-year period, you've actually got money that you can dip into to help you make those repayments. Now, when I say against the loan, what I mean is typically having an offset account. Now, what an offset account is, it's an account that a bank will allow you to have. It's a normal transaction account whereby you put money into that account, but in doing so, the bank has a formula behind the scenes that it treats it exactly the same as had you put the money onto your loan. Okay.
Yeah.
However, you have preserved your ability to maintain the level of debt, which is super important on investment debt, and enables you then to use those funds down the track for whatever purpose without ruining your tax position.
Yes. So dumbing it down for Auntie here. So if you've got $100,000 loan that you're paying interest on, and you have $50,000 in an offset account against that loan, you're only paying interest on $50,000 of the $100,000 loan. Yeah.
Correct.
Yeah.
So your repayment might not go down, particularly if it's a interest and principal repayment. You might still be required by the bank to make the same repayment. However, you're paying a higher proportion of that repayment as principal instead of the interest, because the interest on 50,000 is less than on 100,000. Therefore, you're getting ahead on your loan sooner. From time to time, you know, you buy a house, you have some needs, you need to buy a caravan, new car, whatever the situation might be. But before reaching out to a finance company to obtain a loan, talk to your bank or your broker and see if you have equity against your property that you can potentially utilize. Now, when I say equity, what I mean is if you have capacity in that loan whereby the difference between the value of the property and say the 80% value against that property, if there is sufficient room within that enables you to get another loan, it is cheaper to use your home equity to get a loan than it is to go to a finance company and obtain a personal unsecured loan for the purpose of a motor vehicle or motorbike, caravan, holiday, whatever the case may be.
Yes. And would that type of equity loan, how do I put it, look better than a personal finance loan? To, you know, if you're then going on to...
I wouldn't necessarily say so.
Okay.
But the key is it's very easy to go and get that car loan with a 30-year loan term. But I would suggest strongly that whatever loan you obtain, that you match it to the life of the asset that you're buying. So, for example, if you do go and purchase a motor vehicle and let's give it a 5-year life, then using that app that you've downloaded, calculate the repayments on that new car over 5 years and then make that repayment over 5 years, even if the bank gives you a 30-year loan term. Okay? That way you're not stuck with just adding debt to your home for an asset that hasn't actually added any value to the home. This one is a big one from my perspective. And everyone will have a different opinion. But this suggestion is to actually keep your day-to-day spending at a bank or a finance institution that is quite separate to where your home loan is. Okay. And it's very easy to just have one offset account where you pull all your savings and all your bill money and all your pay and basically all your money into that one offset account against your owner-occupied home loan. But it's also very easy when it's all pulled together to dip into that bucket and to dip into that bucket and end up redrawing and spending all of that money without having a clear and distinct purpose. And one way to do that is to keep your day-to-day bills money and spending money separately at a bank that perhaps has a branch network with low-cost account and an ATM card, and then all of your serious savings, money that you're putting away for a holiday, money that you're saving up in advance for the new car that you're going to buy, putting that in the account at a bank that you basically don't access very frequently and you don't touch it. And it's a lot harder then to dip into that money. Okay?
Yes, it would require quite a lot of discipline, wouldn't it? Yeah.
My other point is to look for a bank that is still super competitive, still got great interest rates and functionality, good reputation, but offers multiple offset accounts. Now, this is something that you won't necessarily know yourself that you can actually obtain. There's quite a few banks out there that will give you one offset account, which forces that mentality of needing to put everything into that one account again. Where there are lots of banks out there that are still very competitive and will give you 10 offset accounts. Now, the beauty of having that is that, similar to what I was just talking about there with siphoning off money, you can use one account for your holiday funds, one account for savings that you will not touch, another account for those extra principal repayments on your investment loan that we were talking about. You can name them accordingly, and you really have it clear. That's money that we can't go and spend. Yes, that is money that, you know, we do have access to if we wanted to spend some luxury items or whatever the case may be. But it's a feature. Ask your bank, ask your broker if that's a feature that you can obtain, and really do compare the different products out there, and see whether you have that option for you next time you look at refinancing your loan.
Great. Okay. Yes, I like that one.
This one, it's all about making sacrifices and swaps. And these are my key tips. It's a bit like if you go on a diet. You might swap from Coca-Cola to Diet Coke. You might have full fat milk to low fat milk. So here are some of my favorites. So think picnics and barbecues instead of restaurants. Okay? You can still socialize, but money that you save doing that, and ask everyone to bring along a dish. Restaurants, choose restaurants where you can BYO. It is phenomenal, the markup that restaurants have of a bottle of wine.
It's how they make their money. That's right.
We touched on this one before, bringing your lunch from home. Instead of eating out. And if that means
bake your own muffins.
Bake your own muffins. Meal prep. Do whatever it takes so that you have that extra time and you're a bit more advanced, and instead of going and spending $20 a day quite easily here in Sydney. Buying your clothes on sale at the end of the season instead of when they first come out. They'll still be around and in perfectly good condition for next season. There are lots of purchases that unfailingly every mid-year and end of year will be on sale. Appliances, towels, linen. Those purchases most definitely will always come on sale, and don't buy them when you need them. Buy them at those times of year.
Exactly. And I was literally just about to say, I get into that mentality of really thinking about it 3 times over. Do you actually need whatever it is you're about to buy? Do you really need it? I know we all like a nice pair of new shoes or a new shirt or whatever it is. You actually need it, right? And we're not saying go without everything forever. Just really churn it over. You know, you're trying to save that $67 a week or more, right?
Exactly. And it can make it easier to make that sacrifice when you kind of put that number, as you say, monetize it. Say, well, that $67 is going to have me paying my loan off 5 years sooner. If I don't spend that and I put that on my loan instead.
That's right.
My other one is swapping coffees and lunch catch-ups for walks or bike rides or healthy, free outdoor exercise sessions.
Controversial, Tina. No, I heartily agree. You know, I do.
And my last point, you never know where life will take you. You know, whether that house that you've bought, you might relocate to another city, you may relocate overseas to a new job. You just don't know. And for that reason, be careful where you make your extra repayments. So many times I see people making their extra repayments into their actual loan, paying down the balance. Therefore, if they ever then make that property an investment property, they've paid their debt down and they've ruined or not maximized their ability to claim that interest as a tax deduction. The way to get around that is when you're making those extra repayments, put it into that offset account that we talked about. So that should you then use those funds in that offset for an around the world holiday, moving overseas, moving states, buying a new car, something that is personal, you can use those funds, but you've preserved that initial limit on that loan so that down the track, if you do rent it out, you've got a nice higher level of debt.
Yes. Fantastic, Tina. And I think just to reiterate that it's crucial that everybody out there talks to the professionals, the brokers, to get advice on how to make those repayments, what your options are, because there really are options. You have options, right?
Yeah, absolutely.
Make a plan, do the budgeting. We'll talk about that in a separate conversation as well. And also you don't, we're not expecting, I always say to everybody, you don't have to live on beans on toast every night, but maybe a couple of nights, there will make some sacrifices, but it is so worth it when you look at the goal, when you look at what that does achieve, right?
Yeah. Yeah, absolutely.
So thank you so much, Tina. Wonderful advice as always. And we will be with you all again very soon with more top property finance tips. So thank you,
Thanks,
Tina.
Kate.
Bye.
Great to chat to you. Bye.
I really hope that you found all of that useful. Tina is a mine of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.